You've drawn this level 100 times. Price taps it, you wait for the bounce. And half the time it holds. And half the time it just slices straight through, like the line was never even there. So here's why that keeps happening. A level price touched and a level where the market actually did business, they look identical on your chart. But they behave nothing alike, and volume profile is the one tool that tells them apart. Fair warning though, once you can see the difference, you kind of can't unsee it. So here's what most of us do every single day. Open a chart, draw a few lines, draw a few more until the thing looks like a spider web, then sit there and wait for a bounce. And look, it works often enough to keep you doing it. That's the trap, really, because here's what that whole approach just can't see. Say a stock trades between $95 and $105 all day. It touches $105 twice, maybe 20 minutes total, and then it spends 6 hours trading around $100. Now, traditional price action says those two levels matter the same. Price visited both, right? Draw the line, call it support. But the market doesn't care how many times price visited a level. It cares where the actual business got done. And once that clicks, it kind of messes with you. You start wondering what half your chart analysis was even built on in the first place. Because price only tells you where the market went. It never told you where it actually cared. And that's the bit volume profile fixes. The slightly annoying part? It's been sitting there in your TradingView sidebar this whole time. Quick one before we go deeper. The frustrating thing about a setup like this is that the cleanest moves don't wait for you. They can happen at 2 in the morning when you're asleep, or when you're simply not at the charts. So what a lot of serious traders are doing now is taking a defined strategy like this and automating the execution. So the rules run whether they're at the chart or not, on a personal account or a prop account, and pairing that with actual one-on-one guidance instead of guessing alone. If that's the direction you're trying to go, there's a link below to book a call with my team. We'll walk you through how it works. Right, back to the charts. So standard volume, those bars along the bottom, that tells you how much got traded and when. Volume profile basically flips that on its side. It tells you how much got traded and where. That horizontal histogram on the right of your chart, every one of those bars is real transactions, stacked up at that exact price. And the wider the bar, the more business changed hands there. Those fat ones, those are your high volume nodes. That's where institutions built positions, where serious size moved. And when price drifts back to one of those levels later on, the market remembers. That's the reason price stalls around these zones. It's why breakouts so often just run out of steam right about here. It was never random. It's price coming back to where the real business got done. But honestly, the part that actually changes how you trade isn't the big fat bar everyone fixates on. It's the gaps. Okay, picture a motorway. Traffic crawls where all the cars bunch up, but hit an empty stretch, and it flies. Markets work on the same idea. High volume nodes. Price slows down, coils up, rotates around. Buyers and sellers agreed on value there, so they sort of hang around and argue about it. Low volume gaps. Price just tears through. Barely any business happened there the first time, so there's nothing to slow it down the second time either. So when I see price heading into a low volume gap, I'm expecting it to accelerate. And when it comes up on a high volume node, I'm watching for a reaction. Two completely opposite behaviors, and both of them are readable in advance, once you know which one you're looking at. Just before we get into the mistakes, don't forget, if you want access to strategies that can run on your rules around the clock, plus one-on-one coaching from our team, click the link below now and join the hundreds of traders already trading smarter with us. Now, here's the mistake nearly everyone makes the week they find this thing. They treat it like a signal. Like, buy at the green bit, sell at the other green bit. It's not a signal, it's a map. So when price comes up on a major high volume node, I get alert. When it drops into a low volume gap, I'm expecting speed. When it comes back to an old point of control, I'm watching how people respond to it. And notice what I'm actually doing there. I'm not predicting anything, I'm just observing. And on its own, look, that map is useful. But a map only turns into a trade when you lay it over market structure, liquidity, and a risk model that tells you what to actually do when price gets there. That's the layer sitting underneath all of this. And it's the part the histogram doesn't draw for you. So here's where that leaves you. Price tells you where the market went. Volume profile shows you where it cared. Put the two together and the candles stop looking random. You start seeing the auction going on underneath them. And honestly, right now, you already understand more about this than most of the people you're trading against. But knowing what the zones are and knowing what to actually do the second price hits one. Those are two very different skills. The map's the easy half, reading it live with real money on the line and the clock running. That's the half you just can't pick up from a 5-minute video, including this one. So if you want to see how I put a full setup together on top of this, the structure, the liquidity, the risk, all the actual decision making, that's exactly what I walk through in the free training linked below. Stay disciplined, keep learning, and I'll see you in the next one.